One of the largest Canadian banks has been recently going through a lot of turmoil, and in fact, the situation looks far from getting better. It is why today I'll share with you a full stock analysis on the Toronto Dominion Bank to see if it is a great opportunity or not at the moment. As always, first I'll check at what is their business model, so how are they able to generate their income, and then I'll make a quick fundamental analysis followed by a price prediction to determine what is the true intrinsic value of it. Without further ado, let's get to it right now. With a market capitalization that exceeds $100 billion, the Toronto Dominion Bank is currently a member of the Big Five Canadian banks, which include other big competitors such as RBC, BMO, BNS, and CIBC. As any great banks, it offers a great variety of financial products and services to their customers, for example, great credit cards, as well as excellent bank accounts, mortgage, and insurance. One of the biggest particularities of this bank is that it is highly invested in the American market as well as other countries all across the globe. Indeed, with over 27.5 million customers worldwide, you can find many different offices of TD in countries such as Canada, the US, Ireland, the United Kingdom, China, South Korea, and Japan. Nevertheless, when we take a look at their lending portfolio, so what is the amount of money that they are lending to their different customers, we can find that with close to $1 trillion of lend, the biggest segments are by far the Canadian market, followed by the US market. Add to this, in their more recent earnings report, we've seen that their net interest margin, which is the interest that is earned by the company divided by its total assets, has been sitting close to 3%, which is in the average of the banking sector. However, this is crucial for you to understand that if the interest rate continued to fluctuate over the next couple of years, this could have a tremendous impact on the total profitability of this company. Similarly, we've seen that their latest earnings per share have been reported at $2.04 per share compared to $1.94 per share last year, and it is also beating the analyst prediction of $1.85 of EPS. However, the negative point about their more recent earnings report have been coming in terms of their total expenses that have been jumping by over 24% year over year, and unfortunately this has had the impact to lower their total net income of about 22%. Obviously, different natural factors can explain these poor results, for example, higher employee costs as well as higher provision for credit losses, which has had the impact, just like their competitors, to reduce their total profit margin. For those that wouldn't know, provision for credit losses are a natural forecast that are made by banks to predict what will be the potential losses due to the credit risk. Indeed, with the numerous hikes of the interest rate over the past 2 years, we've seen that this has had a negative impact on their borrowers and in their capacity to pay back their debt. Add to this, their more recent anti-money laundering problem has had a negative impact on the confidence of the investors towards this bank, and this could also represent a massive fine of $2 billion for this bank. Concerning this problem, it has already been stated that TD has taken an initial provision of $450 million linked to this inquiry, but this isn't the only negative impact that this has had on the company. In fact, the biggest blow that TD has took since the beginning of the year has been a big cut of over 10% of their total valuation since the beginning of 2024, and obviously this has heightened the confidence problem that many investors has toward this big Canadian bank. Over the past couple of weeks, we've notably seen that the Cardinal Capital Management Group, which has been investing in TD for ages now, has started to sell all the position that they own in this bank. This news came close to 1 year after the sad anniversary of the termination of the First Horizon acquisition of TD that has cost them over $200 million of break fee. So the least we can say is that this bank has been going through some rough times lately, which has made them lost a lot of valuation over the last couple of years. Obviously, with their appetite for long-term growth, TD has made some bad plays in the past. For example, they tried to acquire the First Horizon Bank, but they've also been able to make some great acquisitions in the past. For example, the acquisition of Cowen in 2023 to expand their US market. Nevertheless, let's see if this 5.50% dividend stock could be a great undervalued company according to the different financial metrics. First, we can notice that TD currently worth about $132 billion with a pretty reasonable price to earnings ratio of about 12 at the moment. And so this would be showing that this stock, according to this factor, would be pretty much fairly valued right now. Then in terms of the profitability of this company, we can see that over the last year, they have been able to achieve some excellent profit and operating margin of over 20% each, while still being able to have a quite fair return on equity of about 10% over the last 12 months. Over this same period, we can see that they've been able to generate some revenue of about $51 billion, however, with a slight diminution in their latest quarterly revenue growth of less than 1%, but most importantly, with a bad diminution of over 22% in their latest quarterly earnings growth. As any great bank, TD also has a lot of cash with more than $545 billion to be able to cover their impressive debt of over $475 billion. In terms of the volatility of the company, as always, I'll be using the beta on a 5 years period, and with a beta of less than 1, it is showing that over the last 5 years, this stock has fluctuated less than the overall market on average. Nevertheless, over the last year, we can see that it hasn't been able to do as well as the market that has returned over 23%, where it has been down by close to 10% year over year. On a brighter note, we can see that this company currently offers close to 5.50% of dividend with a super low payout ratio of only about 66%, which is showing that the dividend is still sustainable in the long term. Over the last 4 years, we can see a great overall progression in terms of the total revenue of this company that have been increasing every single year. But on the upper hand, since 2023, we can see an important decrease in their total net income, which was mainly driven by higher expenses. When we take a look at the cash flow of this company, we can see that since 2023, their total free cash flow have been massively diminishing to become negative. And in fact, this was mainly driven by lower cash flow from operating activities that were driven by lower change in working capital. But now when we look at the project value of this company, as always, I'll be using many different evaluation models, starting out with the Peter Lynch valuation one, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the price to earnings ratio. And with these variables and with some low EPS growth that is predicted for the next 5 years, we can see that the results are showing that this stock would currently be overvalued. Now for our second model, which is a dividend discounted model, it is a simple model where we will simply use the dividend payout of the last 5 years to find what would be the true value of this company. And with our weighted average cost of capital, we find that the intrinsic value would only be of $15, which would represent a massive overvalued company. Now in terms of the third model, which is the discounted cash flow model, where in this case we'll be discounting the future cash flow of this company. First, we need to find what is our weighted average cost of capital by finding our cost of debt, the cost of equity, and the cost of debt and equity. And then we can find that the intrinsic value of this company would currently be of less $155 since we have some negative free cash flow in 2023. And so you can understand that with this hypothesis, this model wouldn't work. And finally, for the last two models, which are the Graham's original value formula and the Graham's revised value formula, we can find that with the original value formula, it gives us an intrinsic value of $87 compared to an intrinsic value of $58 for the revised value formula. And so it means that in the first case, it would be a buy, so the stock would currently be undervalued, and in the second case, it would be a sell, so it would be currently overvalued. At the end of the day, with all the negative news that have been impacting the value of this company, I personally believe that the anti-money laundering problem combined with the First Horizon problems are more some short-term problems. The company is currently going through some important restructurations where they are trying to grow as much as possible, especially in the US market, as well as giving some great stability to their different investors. Add to this, the valuation models are showing some pretty mitigate results about the true intrinsic value of this company, and with their more recent negative free cash flow and their project growth that is expected to be pretty slow, this could be an interesting pick for you if you are strictly looking for great dividend stocks but not that much for a great growth stock. So on your side, if you're currently looking for other Canadian alternatives to this Toronto Dominion Bank, well, check out the video that's gonna be right over here, and I will see you soon. Peace.